Welcome to the deep dive. If you've ever looked at investing, stocks, bonds, your 401k, and wondered, well, what's the bedrock? What really builds that lasting multi-generational wealth? You're in the right place. Today, we're really digging into real estate investing. We're looking at why it's so often seen as maybe the most effective, the most reliable way to build serious long-term financial security.
That's exactly it. Our mission today is to get past the usual real estate is good line. We want to uncover the specific financial gears, the structural things that make it foundational for so many strategies. We're aiming to break down the full picture, the stuff you don't always hear in the basic guides.
Right. So maybe let's just quickly set the stage. Why do people invest in the first place? I mean, our sources boil it down to what? Four main goals: security, growth.
Generating passive income, that reliable income stream, and of course, building that long-term generational wealth.
Okay. And we know the usual suspects: savings accounts, bonds, stocks.
Exactly. And, savings give you safety, but almost zero growth. Stocks can offer huge growth potential, but wow, the volatility can be intense. Real estate, though, it seems almost uniquely set up to tackle all four of those goals together. Like a mix of something physical, finance strategy, and, interestingly, some pretty helpful tax laws.
Okay, let's unpack that. Our sources flag about 7 core advantages. We really need to get into the how and why for each one. Where should we start? Maybe with the asset itself, its physical nature.
Yeah, that's a great place to start. The idea of a tangible asset. It's fascinating. When you buy stock, you own a piece of paper, well, digitally nowadays, representing a claim on profits, right? But real estate, it's actual land. It's a building. It's physical. And that physical nature gives it this inherent value that's really hard to wipe out completely. It definitely adds to that feeling of, fundamental security.
And because it's physical, it's right there, you get this element of control and creativity. You can actually influence your investment's performance in a way that's it's almost impossible with stocks or bonds. If your stock portfolio tanks, what can you do? Sell, wait, hope.
Right. But with an investment property, if it's not performing, you've got options. You can, retain, redo the kitchen, hire better managers, improve the curb appeal. You're putting in actual effort, maybe sweat equity, making real operational choices that can directly boost the property's value and its income. You're driving the outcome, not just reacting.
Okay, so we've got the security of a physical thing, plus the power to directly make it better. That leads us right into the money side: cash flow and appreciation.
Cash flow is pretty straightforward, right? It's the rent you collect each month minus all your costs, mortgage, taxes, insurance, maintenance, stuff like that. And unlike a stock dividend, which a company can decide to cut whenever they want, this cash flow comes from the basic utility of the property. People always need a place to live.
And while that cash flow is coming in, hopefully, appreciation is working in the background. Property values tend to grow over time. Now, the stock market can jump all over the place based on headlines, but real estate appreciation is often steadier, maybe more predictable over the long haul, like decades. It feels built for patience, less emotional whiplash.
Exactly. And you need to see how these two work together. Your tenants are generating cash flow, which is helping pay down your loan principal, while at the same time, the entire property value is hopefully appreciating. So you've got these two wealth-building streams happening simultaneously on the same physical asset. It's powerful.
That combo debt paydown plus appreciation is strong. But I think there's another layer, maybe a hidden superpower: how real estate interacts with the bigger economy, like inflation and especially the tax system. Let's talk protective measures. Inflation first.
Yes, the inflation hedge. This is really crucial for anyone thinking long-term. When inflation pushes up the cost of, say, lumber and labor, the cost to replace existing buildings goes up too. That tends to support higher property values. And critically, rents usually climb with inflation as well.
Okay, so think about this. Money sitting in your savings account. It's actively losing buying power year after year because inflation eats away at it. But your real estate asset and the rent it brings in, they tend to rise with inflation. So that safety aspect isn't an opportunity cost, it actually becomes part of the opportunity.
Perfectly put. And that brings us to the tax benefits. Honestly, this is where things get really interesting for wealth building in real estate.
Yeah, this is huge. Like with stocks, you sell for profit, you pay capital gains tax. Simple. But with real estate, the rules are just different, mostly because of something called depreciation.
Depreciation. This is the one people often miss or misunderstand. The IRS lets you deduct a portion of the building's cost, not the land, just the structure over a set time. For residential, it's usually 27.5 years. Now, here's the key. This is a non-cash expense. It's an accounting thing. Your property isn't actually crumbling or losing market value necessarily.
Yeah, it might even be appreciating.
Exactly. But the government lets you pretend it's losing value on paper for tax purposes.
So it's like a phantom expense that shields your actual rental income. You might collect, say, $15,000 in rent over the year, but after you deduct your real expenses like mortgage interest and property taxes, and then you deduct maybe $10,000 in depreciation, suddenly your taxable income from that property looks much, much smaller, maybe even zero or negative. And that loss can sometimes offset other income you have.
Absolutely. It dramatically reduces your current tax bill. And then when you eventually decide to sell that property, assuming it's gone up in value, there's another major tool, the 1031 exchange.
Oh yeah, the 1031. This is a game changer. Normally, you sell an asset, make a profit. Uncle Sam wants his cut right away through capital gains tax. But a 1031, sometimes called a like-kind exchange, lets you sell investment property A and roll all the proceeds directly into buying investment property B as long as it's of equal or greater value. And you defer paying those capital gains taxes.
You defer them potentially indefinitely if you keep exchanging. This is how you really accelerate growth. You're using your pre-tax profits to buy bigger and better properties over time. Now, we should be clear, it's not a free pass. The rules are pretty strict. You've only got 45 days after you sell property A to formally identify potential replacements, usually up to 3. And then you have to close on one or more of those identified properties within 180 days total from the initial sale. So it takes planning, definitely. But the tax deferral, monumental benefit.
It's massive. But if we had to pick the single biggest accelerator in real estate wealth building, it's probably leverage, right? This concept seems absolutely central.
Leverage, yeah. Simply put, it's using borrowed money, usually a mortgage, to increase the potential return on your own invested capital.
Okay, give us an example. Like you want to buy a $500,000 property. You don't pay $500,000 cash. Most people don't. Maybe you put down 20%, which is $100,000. But you now control the entire $500,000 asset, even though you only put in a fraction of the cost.
Exactly. Now think about the return. Let's say that $500,000 property goes up in value by just 5% in 1 year. That's $25,000 in appreciation. But wait, you only invested $100,000 of your own money. So that $25,000 gain represents a 25% return on your cash invested. And that's before we even count any cash flow or the fact that your tenant helped pay down the loan principal.
Whoa, okay, that sounds amazing. 25% return is fantastic. But we have to talk about the flip side. Doesn't that leverage also massively increase your risk? I mean, if that $500,000 property drops by 5%, that's a $25,000 loss. That wipes out 25% of your initial $100,000 investment rate.
That is absolutely the risk. It's the essential trade-off. Leverage magnifies gains and it magnifies losses. And this is why that control aspect we talked about earlier is so critical. Real estate risk isn't just market swings like stocks. A big part of it is operational risk. Can you keep the property rented, maintained, managed well? You mitigate the financial risk of leverage partly by ensuring the property generates enough cash flow to cover its debt payments, the mortgage. If it can do that, you can usually weather temporary market downturns. Your tenant is effectively paying down your debt while you wait for the market to recover. So yes, leverage is a double-edged sword. But in real estate, you, the investor, have more direct ways to manage that risk compared to just hoping the stock market goes up.
That makes sense. So when we take this whole structure, the tangibility, control, cash flow, appreciation, inflation hedge, tax benefits, and leverage, and compare it directly to the other common investments, how does it stack up?
Well, let's start with real estate versus stocks. We touched on tangibility. But maybe the biggest difference day to day is volatility. Stocks can be bought and sold instantly, which makes them prone to emotional, news-driven swings. Panic selling is real. Real estate is fundamentally illiquid. You can't just rage sell your rental house in an afternoon.
Yeah.
And that illiquidity, strangely enough, often forces a longer-term perspective, which tends to lead to better results.
Yeah, and the emotional side is different too, isn't it? Watching a stock ticker feels like gambling sometimes. Managing a property, it feels more like running a small business. You're dealing with practical things, leases, repairs, finding good tenants, maybe planning an upgrade. It's active management of an asset, not just reacting to market sentiment about some CEO you'll never meet.
Exactly. Now, compare real estate versus bonds. Bonds are generally seen as much lower risk, they provide fixed income, and they're usually pretty liquid. They definitely have a place for stability in a portfolio, but you sacrifice significant growth potential. Bonds just aren't designed for high returns. Real estate is definitely higher risk because of the illiquidity, the management needs, the leverage, but the potential returns amplified by that leverage and the tax advantages. It's just in a different league than bonds.
And finally, the easiest comparison. Real estate versus savings accounts. Savings offer near perfect safety and immediate access to your cash. But as we said with inflation, that safety guarantees your money loses purchasing power over time. It's a slow erosion. Real estate safety is different. It's tied to a physical asset producing income that ideally keeps pace with the economy.
Yeah, it's really the difference between holding on to paper money versus building tangible, real-world value.
Okay, so despite all these advantages, which sound pretty compelling, our sources point out there are these common myths or misconceptions that stop people, especially beginners, right in their tracks. We should probably tackle those head on.
hmm The first big one is always, you need a ton of money to get started in real estate. The barrier to entry myth.
Right, but our whole discussion about leverage kind of debunks that, doesn't it? You're not paying cash for the whole property. You need the down payment closing costs, which is still significant, but not the full price. And there are other ways too, right? Like house hacking, renting out rooms in your own home, or partnering with others. Those can lower the cash needed upfront quite a bit.
Definitely. The second misconception is it's just too risky. And yes, all investing has risk, but we established that a lot of real estate risk is operational, meaning you can influence it. If the market dips, you focus on keeping it rented. If something breaks, you fix it. You have agency. Stock market risk often feels systemic, like what can you do about global events or market crashes? Not much, usually.
Good point. And the last one, you can't be hands off. It means dealing with tenants and toilets at 3 a.m.
Yeah, people often equate investing in real estate with being the landlord who does everything. And you can do that, sure. But the beauty of real estate is that it's also perfectly designed for passive income if you want it. You hire professional property managers. They handle the day-to-day headaches, the tenants, the maintenance calls. Your job as the investor becomes finding the deal, arranging the finance, setting the overall strategy. You can benefit from the appreciation, the loan pay down, the tax breaks, without being the one fixing the leaky faucet.
Okay, to really drive home how powerful these combined effects are, the appreciation, cash flow, tax shielding, and especially that leverage. Let's run through that simple comparison scenario. It really highlights the difference.
Let's imagine you have $100,000 right now, ready to invest, and you're looking at a 10-year horizon.
Option one, put it in a high-yield savings account. After 10 years, well, with interest rates and inflation, your actual purchasing power might be pretty flat, maybe even a little lower than when you started. Safe, but no real growth.
Okay, option two, a diversified stock portfolio. Let's be optimistic and say it averages a solid 7% annual return. After 10 years, that $100,000 grows to roughly $200,000. That's doubled your money pretty good. But when you sell those stocks to realize the gain, you'll owe capital gains tax on that $100,000 profit.
Now, option three, real estate. You use that same $100,000, but as a 20% down payment to buy a $500,000 property using leverage. Let's assume, maybe conservatively, it appreciates at 4% per year. Over 10 years, that $500,000 property increases in value by about $240,000.
And here's the kicker. That $240,000 growth happened on the entire $500,000 asset value, not just on your initial $100,000. Plus, over those 10 years, your tenants have been paying rent, which covered expenses and paid down a chunk of the original mortgage principal, building your equity further. And your cash flow along the way was likely sheltered significantly by depreciation. So the total impact on your original $100,000 is magnified massively by the leverage, the debt paydown, and the tax efficiency. The overall return often blows the stock market example out of the water over that same period, precisely because your returns were calculated on the larger leverage asset base. That compounding effect on a leveraged asset. That's the engine.
Wow. Okay, so let's quickly recap this deep dive. Real estate's power seems to come from it being, well, real. A tangible asset you can control. It offers this incredible financial booster rocket through leverage. It provides unique protection against inflation. And the tax structure, with things like depreciation and Lin 31 exchanges, is just exceptionally favorable compared to other investments.
It really is a unique combination. And so this kind of leaves us with a question for you, the listener, doesn't it? If the advantages, especially around leverage and taxes, are so clear, and if the main thing holding people back is often just that initial hurdle thinking you need vast sums of money or that it's too complex, what's one small thing you could do today? What resource could you find or what first step could you take just to start learning more and maybe overcome that initial barrier? The potential is clearly there. Maybe the next step is just finding the right guidance to get you started on finding that first opportunity.